In less than 48 hours, silver went from the kind of price you usually see only in history books to the kind of price you usually see only after a forced unwind. It pushed up to around $121 an ounce. And by February 2nd, 2026, it was trading in the high 70s. Not months, not weeks, 48 hours. Reports described a one-day drop near 31%, the kind of single-session collapse most people associate with 1980, not with a modern electronic market that is built to feel smooth. They said moves like this could never happen anymore, that risk models, deep liquidity, and automated market making made the old commodity panics obsolete. But the truth is simpler. When leverage builds in a market that is smaller than it looks, and the cost of holding that leverage rises suddenly, price does not move like an opinion. It moves like math. Here's the part most people miss. Institutions understand how this story works because they operate inside the rulebook that governs the exits. By the time the public notices the crash, the collateral calls have already gone out, the margin tables have already updated, and the largest players have already adjusted exposure. The headline says silver collapsed. The mechanism says something else entirely. What follows is not a rumor, and it's not a conspiracy, it's a sequence, it's timing. It's a repeatable playbook the market has used before, updated for modern plumbing. Once you see it, you can't unsee it, because the supposedly random chaos begins to look engineered by incentives and constraints. Welcome to Signal and Noise, where we decode what matters before it becomes a headline. If you like calm, data-driven breakdowns that explain why markets move the way they do, stay close to the channel. And drop a comment with where you're watching from, because this story lands differently depending on what market you live inside. Now, let's reconstruct what actually happened. The silver surge into late January 2026 wasn't a gentle rise, it was vertical. The kind of climb that turns cautious buyers into late buyers, and late buyers into leveraged buyers. The narrative around it was familiar: industrial demand, supply tightness, uncertainty, and shifting expectations about rates. Reports also noted heavy inflows into silver exchange-traded products, around $1 billion flowing in during January alone. That kind of money is a loud signal, not because it guarantees a direction, but because it shows crowding. Crowding is what turns a market move into a market event. A second layer of fuel came from the way silver is traded. Most people don't buy bars and store them. They buy vehicles that behave like bars, or they trade contracts that behave like exposure. That difference seems like a detail until volatility hits. When an ETF gets inflows, the investor's risk is generally limited to the cash put in. When a futures position is built with leverage, the risk is not limited by belief. It is limited by collateral. If collateral is demanded and can't be posted, the position is reduced, whether the trader agrees or not. In the final stretch of the run, price action stopped looking like discovery and started looking like acceleration. Intraday swings widened. Liquidity got patchy. That's often the moment the crowd feels most confident because the chart is confirming the story. But it's also the moment risk systems begin to tighten because volatility is the input that tells them the market is becoming unstable. And then came the snap. Between roughly January 29th and January 31st, volatility across precious metals surged. Gold was hit as well, but silver, because it is thinner and more leverage sensitive, absorbed the full force of the unwind. Inside that same window, the exchange environment changed. The CME, the dominant venue for U.S. precious metals futures, raised precious metals margin requirements on January 31 after the violent move. If you've never had to post futures margin, translate that into plain language. The exchange increased the cash required to carry the same exposure. In a calm market, a margin change is a footnote. In a fast market, it's gasoline. The same exposure now needs more cash. If the cash isn't available, the position must shrink. That's not an argument. It's a forced sale. At the same time, broader macro messaging shifted. Headlines emphasized changes in rate expectations after Donald Trump announced a nominee for Federal Reserve Chair, Kevin Warsh. Markets trade expectations, and a stronger dollar narrative can weigh on commodities and the story people tell. But explanations are not mechanisms. The mechanism is collateral and positioning. The macro story is what most people use to make the candles feel logical after the fact. So the central mystery is this: how can a market that appears to be drawing demand, visible through inflows and excitement, still collapse like a trapdoor? The answer lives in the gap between demand and the ability to finance that demand. To see the pattern, you have to step back. In 1980, silver experienced what later became known as Silver Thursday. The market had been driven by concentrated buying and leverage. Then financing conditions changed, constraints tightened, and the unwind was brutal. The public saw a sudden reversal. Participants remember a sequence: collateral pressure, forced selling, and cascading liquidations that fed on themselves. The lesson of 1980 is not simply that price can fall. It's that when a leveraged market loses the ability to finance positions, price can fall faster than almost anyone thinks is possible. In 1998, the same principle showed up in a different costume. Long-term capital management didn't unravel because every idea was wrong. It unraveled because leverage met widening spreads, and funding stress turned manageable into unmanageable. The lesson transfers cleanly. When the cost of carrying exposure rises and liquidity thins, positions that look stable in a model become unstable in the market. In 2011, silver ran hard again and then fell hard. Market veterans still talk about that episode because of the way leverage constraints arrived late in the move. As the price rose, risk controls tightened and margin requirements were raised repeatedly. Those changes may be prudent from a system perspective, but they have a predictable effect. Margin hikes near a crowded top flip the market from voluntary buying to involuntary selling. You don't have to believe in manipulation to recognize a pattern that repeats when rules and leverage collide. Now look at 2026, a rapid rise, a crowded narrative, visible demand signals, and then sudden tightening of leverage conditions as volatility explodes. The market doesn't need a villain to behave like this. It needs a constraint. And the constraint is institutional. People imagine institutions as a single actor. In reality, it's a network. Exchanges setting margin policy, clearinghouses managing counterparty. Risk, brokers passing requirements to clients, banks adjusting liquidity lines, and large funds managing exposure across multiple venues. None of these actors has to coordinate in private. They coordinate through rules. When volatility triggers risk models, the rules synchronize behavior. Start with the exchange. CME margin policy is designed to protect the clearing system. When volatility rises, margins rise because the probability of large adverse moves rises. That's the public explanation. The market impact is mechanical. A trader holding a position must either post more collateral or reduce size. If thousands of participants face that at the same time, the market becomes a liquidation lane. Reports also described a shift toward more percentage-based approaches in precious metals margining, with figures cited around a roughly 10% initial margin for silver in some coverage. The exact percentage matters less than the principle. If margin is a percentage of notional, then as price rises, required collateral rises automatically. That makes leverage less stable near the top. It's like climbing a hill where the slope steepens as you approach the crest, so the effort increases exactly when fatigue is highest. Now add clearing members and brokers. When the exchange raises margin, brokers often raise it further because they manage their own risk and capital constraints. A trader may see an exchange requirement and then a broker requirement that is higher. The result is the same. More cash is needed. And in a fast move, cash is the only thing that matters. Then there's variation margin, the part that hits like a heartbeat. Futures are marked to market. Losses are paid in cash as prices move. In extreme volatility, those calls can become intraday. That means it's not only that the required base margin goes up, it's that cash leaves accounts faster than many participants are prepared for, especially if they were sized for a quieter market. That is how a position that looked fine on Monday becomes impossible by Wednesday. Now add the funds. Commodity trading advisors, volatility targeting strategies, and multi-asset risk controls can reduce exposure when volatility spikes. They do it because their models say risk has increased. That means they sell as volatility rises, which can push volatility higher, which triggers more selling. A feedback loop. Now add the real economy hedgers. Producers and industrial users hedge to reduce uncertainty. When volatility explodes, hedging programs often become urgent, either because limits are hit or because internal risk committees demand changes. Urgency in a thin market produces impact, even when the hedger's motive is stability. Now add the banking layer. Lines of credit and financing terms are not static in a stressed moment. When volatility jumps, financing can tighten, haircuts can rise, and liquidity can become more expensive. That doesn't always show up on a chart, but it shows up in who can hold positions through the storm. And finally, add the reality of silver itself. Silver is not a vast equity index. It's a comparatively small market with a large derivatives footprint. The paper market can represent multiples of deliverable inventory because most contracts are closed out financially. That works fine until many participants want the same exit at the same time. Then liquidity shows up as a mirage, present in normal conditions, absent at the moment it is needed. This is where the dislocation becomes visible. On one side, you have public demand signals like ETF inflows. $1 billion of inflows in a month is not quiet. It says investors are leaning in. It says the story is popular. But popularity is not collateral, and it is not the same as the ability to hold leveraged exposure when rules tighten. On the other side, you have the futures market where leverage is cheap when volatility is low and expensive when volatility explodes. As price surges, notional exposure grows. As volatility rises, required margin grows. In other words, the same move that creates excitement also increases the cost of staying in the trade. Those two sides can point in opposite directions. ETFs can be absorbing demand while futures are forcing liquidation. That is how you get a market that looks strong in conversation and weak in price at the same time. The two markets are not lying. They are revealing different constraints. There's another split that shows up in episodes like this: paper price versus physical friction. When futures are being liquidated, the quoted price can fall fast, but the physical supply chain does not instantly reprice with the same smoothness. Refining, minting, shipping, and inventory cycles are real. That can create moments where the futures screen shows collapse while availability tightens and delivery takes longer. It's not that the physical market ignores price. It's that the physical market has latency, and latency creates gaps that cannot last forever. This is also why the chart can show a crash while the underlying need for metal doesn't vanish overnight. Industrial buyers don't stop soldering, wiring, or manufacturing because a futures candle turned red. They hedge and they negotiate. The cash market adjusts with invoices and delivery schedules, not with a single click. So the paper market can overshoot on the way down, just as it overshot on the way up, because forced selling cares about timing, not value in the real world today. Now, put numbers on the footprint, because this is not about vibes. A peak around $121 an ounce, followed by trading near $77 by February 2nd, is a decline of about 44. Translate that into contract terms. A standard COMEX silver futures contract represents 5,000 ounces. A $44 move is about $220,000 of notional swing per contract. If that exposure was financed with leverage, the swing doesn't just dent a thesis. It consumes margin equity. It triggers calls. It triggers reductions. And when the tape prints a one-day move described near 31%, that is not a normal repricing. That is an unwind. It is the signature of forced selling into thin liquidity. A move like that doesn't require a new scientific discovery about silver. It requires an imbalance between how many people want out and how much collateral they can post to stay in. Here's where it gets interesting. The public explanation, focused on shifting rate expectations and the dollar, can be true and still incomplete. Macro shifts can provide the spark, but the size of the fire is determined by the fuel. The fuel was leverage, and the oxygen was liquidity that vanished under stress. If you want an analogy that works without a finance background, picture a crowded theater. Everyone is seated. Now imagine an announcement. Tickets must be fully paid right now, or you must leave your seat. It doesn't matter whether the show is good. It doesn't matter whether you plan to stay. People who can't pay stand up immediately, and if enough people stand up at once, the aisles jam and the exits clog. The rush itself becomes the problem. Margin hikes are that announcement. And the market's plumbing is the exit door. In modern markets, the clearinghouse sits at the center. Its job is not to make anyone comfortable. Its job is to ensure trades settle even if price moves further. When volatility spikes, it demands more collateral. That protects the system. But it also changes the game for anyone using leverage, because the cost of holding exposure rises instantly. Now, if this is risk management, why does it feel engineered? Because timing is everything. Margin increases tend to cluster near extremes because volatility tends to spike near extremes. That means the rule changes often arrive when the market is already stretched. The result is amplification. Not because someone wants a crash, but because the system is designed to survive a crash, and survival requires collateral. This is also why you often see a strange sequence. Price surges, headlines become euphoric, and then the market breaks in a way that seems disproportionate to the news. What changes in that moment is not the public narrative. It's the private cost of carrying positions. Now think about who thrives in that environment. Large institutions often have deeper collateral pools and cheaper financing. They can meet margin calls. They can wait. Smaller participants, or participants who arrived late with leverage, often cannot. They are forced out at the worst prices, not necessarily because their long-term story was wrong, but because their short-term financing was fragile. This is how information becomes a wealth gap. The wealthiest players are not always the best storytellers. They are the most resilient to mechanics. And the evidence becomes hard to ignore when you look at the sequence. A sharp rise into late January, a volatility spike, a margin increase on January 31st, a continued pressure period into early February with price far below the highs. That is a classic deleveraging signature. It is what markets look like when the dominant trade shifts from voluntary buying to involuntary selling. You can also see the broader repricing in how related metals behaved. Reports described gold falling sharply from its own recent peak, with talk of roughly $1,000 of downside from the high during the same stress window. Again, the point is not the drama. The point is that the entire complex was being repriced as carrying risk became more expensive across the system. Now, let's talk about the mechanism in a clean chain, because this is the step that turns mystery into math. First, price rises rapidly and attracts attention. Second, leverage increases because futures and leveraged products offer amplified exposure. Third, volatility rises because the market becomes crowded and liquidity thins. Fourth, risk systems respond to volatility by raising margins and tightening limits. Fifth, higher margins force participants to post more collateral. Sixth, participants who cannot post collateral reduce positions, creating selling pressure. Seventh, selling pressure pushes price lower, which increases stress, which produces more selling until the system finds a new balance. That is how it is executed. Not by a single hand, but by a chain of rules. There's a reason this feels cruel. The tightening arrives when people are most committed. The collateral demand arrives when price is least forgiving. And the liquidation happens quickly enough that it looks like the market changed its mind. But the market did not change its mind. The market changed its financing conditions. Now bring that back to the core contradiction. The public can see demand through inflows and chatter. The public cannot see the private margin tables, the broker overlays, the intraday risk limits, and the funding haircuts. The public sees the story. Institutions see the constraints. When constraints tighten, the story becomes irrelevant for anyone who cannot finance it. So what does this imply going forward, historically, without pretending to predict? When a leverage-driven market breaks, the next phase is defined by liquidity. One possibility is stabilization through exhaustion. Forced sellers are flushed out, volatility declines, and the market finds a new equilibrium where positions are smaller and leverage is lower. In that environment, price can begin to reflect supply and demand again rather than collateral pressure. A second possibility is aftershocks. Collateral requirements remain elevated, liquidity remains thin, and any renewed volatility triggers another wave of forced selling. The chart can look like it is trying to rebuild and then gets knocked back because the system is still sensitive. A third possibility is a regime shift. Liquidity providers widen spreads, leverage becomes structurally more expensive, and the market adopts a new personality, where air pockets appear more often and ranges expand. In that regime, even modest news can produce large moves because the depth is lower. None of those outcomes is guaranteed. They are patterns that have followed similar mechanical breaks across decades. The honest takeaway is not certainty, it's awareness of the mechanics that tend to dominate after a break. So what can be observed if the goal is to understand rather than to guess? Watch volatility. When volatility compresses, mechanical sellers tend to quiet down. Watch margin policy and broker behavior because elevated margin keeps leverage constrained. Watch whether price reacts to small news with large moves because that is a signal of thin liquidity and fragile positioning. And watch the relationship between public demand signals and price. When inflows and enthusiasm remain strong while price remains weak, it often means the futures plumbing is still the controlling force. All of this brings us back to the title. This was not a crash in the emotional sense. It was a crash in the mechanical sense. The market did not decide to punish anyone. The market enforced collateral discipline. And when collateral discipline collides with crowded positioning, the result is a waterfall. The divide is not between bulls and bears. It's between those who think markets are stories, and those who understand markets are also infrastructure. Stories move sentiment. Infrastructure moves settlement. When infrastructure demands cash, sentiment becomes irrelevant. This is why retail participants are so often late to the exit. They learn the narrative first. Institutions learn the mechanics first. Institutions see margins, funding conditions, and risk limits tightening before the public sees the full red candle. By the time the public debates what happened, the mechanical phase is already underway. If one lesson is worth carrying forward, it's this. The most important moments in markets are often the moments when two signals disagree. When demand looks strong, but price collapses. When the story sounds bullish, but the mechanics are bearish. That disagreement is not a contradiction, it's a clue. And once you train your attention on the clue, you stop being surprised by the speed, because the speed is the point. Mechanical unwinds don't wait for consensus. They happen when collateral thresholds are breached, and they stop only when enough leverage is gone. This is signal and noise, where we decode what matters before it becomes a headline. If this connected dots you hadn't seen, you know what to do. The question isn't whether markets can move like this, you've just watched them do it. The question is whether you'll recognize the mechanics before the next 48-hour move turns a crowded trade into a trapdoor.